Well, hello and welcome to another Gower Crowd podcast with your host, Adam Gower. And today we have probably one of the brightest guys I've ever met right on the show, Paul Keough of TurnKeough Wealth Management, who discusses some fascinating insights into how the world of wealth managers and RIAs handle private equity real estate investing. Check this out. Paul has an MBA in finance from University of Michigan's Ross School of Business and a PhD in biochemistry from Northwestern. I have been fascinated in how the wealth management industry integrates private real estate into its usual practices and usual bonds and stocks and bonds, etc. And so was delighted when a client of mine, thank you, Ed, made the kind introduction to Paul. There is a lot to learn from Paul, as you might imagine, both as an investor and also as an RIA or wealth manager. We talk about the pros and cons of private real estate, how to succeed in private real estate in a recession, how to use an IRA to invest in private real estate, and particularly interesting to me is how Paul explains the structure that he puts in place at his practice to invest in real estate on behalf of his clients. Now, to be clear, I am not a financial advisor, so be sure to contact Paul if you've got any questions. You can find all his contact information on the podcast page for today's episode at gowercrowd.com, where you'll also find links to the whiteboard workshop, which, if you've not seen it yet, is a training I put together that shows you the exact system that we build for for our private real estate clients who want to raise money online for their projects. You need an RIA, but you also need a good online presence, and that's exactly what you'll get in the investor acquisition system, about which you can learn everything in the whiteboard workshop on the podcast page there at gowercrowd.com. Okay, let's get into it with Paul Keough, MBA, PhD of TurnKeough Wealth Management, to hear how private real estate fits hand in glove with the wealth management industry. Paul Keough, TurnKeough Wealth Management, what a pleasure to see you in these crazy times that we are having right now. I am dying to hear from you what wealth managers think about the world of real estate. So why don't we kick off with my first question that you and I have been talking a lot about back and forth on what we're going to chat about. So let's start with, what are the strengths, and from your perspective, particularly as a wealth manager, what are the strengths and weaknesses of public real estate? You can certainly contextualize that in this crazy COVID-19 world in which we are all surviving and thriving, some of us. Go ahead, Paul, floor is yours.
Thanks, Adam. Thank you for having me on your show. And I'm happy to speak to your crowd and help investors. We're helping small businesses and investors right now. We can't move fast enough. We can't get to enough people. We have so many people who need help. Real estate has definitely some advantages. The public side, of course, you have liquidity. It's public, so you can track it, and there's better transparency. There's also what's called a tax pass-through, where part of your investment, when it's returned to you as a distribution, can be perceived as a return of capital instead of income. So there's that advantage. The disadvantage is it moves like the market. So we've seen public real estate drop 37% this last month, and that's upset a lot of people. And we knew that real estate was at a high premium, but really, if you think about it, if you were selling your home, Adam, or if I was selling my home, it's not like our house actually changed in any perceivable way in a month. But if it was publicly traded, it would have dropped 37% in its unrealized loss. So that's the disadvantage of public real estate.
Wow, that's interesting. Actually, let me just drill down on a couple of thoughts there. So when we're talking about public real estate, we're talking about things that are traded as though they were a stock, like REITs. Is that right? That's what you're referring to there.
Correct. So a real estate investment trust is bits and pieces and parts of properties. And that was the problem in 2008, is that the derivatives mathematicians with PhDs like my brother Charlie were chopping up all of these houses into little bits, and no one could determine what part you owned, if any. And so that's where REITs got a bad name. But traditionally, the good part of REITs is when it's real assets and you actually own things, which most REITs do. And then they're traded publicly because people see real estate like any other industry. Some people want to buy it, some want to sell it, and therefore there's a tradable market.
Okay, right. And so they do behave like stock. So now the next thing is, what is the difference between private and public real estate mixes, and what are the strengths and weaknesses of both of these?
That's right. So the strengths of private is that there's always a delay in any kind of correction. So just like you and I, if we sell our house, nothing changed with my shingles or my brick or my fireplace. And so for it to drop 37% in 1 month, it just doesn't make any sense, right? So on the private side, when we do a private transaction, you are shielded from the public market to a certain degree, and this time you can see is a good thing right now at this time. And there's a lot of diversification on the private side. Just like I was a venture capitalist in the past. On the private side, you tend to see new ideas. You tend to see better, cheaper, faster ideas. The brightest minds are often on the private side. So you see creative things in real estate and new ideas in real estate that you don't tend to see on the public side. The weakness is, of course, lack of transparency. It's not traded, lack of liquidity. It's hard to get out of it, right? Because like you and I trying to sell our house, we need a buyer. And if the buyer backs out, we don't sell our home. And if they don't come to the close, we don't sell our home. If the loan doesn't come through. So there's a lot of limitations on the private side that would dissuade people. But right now, it's a very good time to be on the private side because valuations haven't really shifted much. And the market is active. And there are a lot of great creative ideas.
So let me ask you, though, from a wealth manager's perspective, there are some who won't touch private real estate, right? Because look, I don't want to put words into your mouth, Paul. You're the expert. That's why you're here. I want to ask you, but with publicly traded real estate stocks like REITs, etc., there are analyst reports. You can look at detailed analytics, whereas the private side, you don't have that advantage. So what is the resistance typically that you think RIAs and wealth managers have to private real estate versus publicly traded real estate?
Yeah, it's a good question, Adam, and it should be something taken seriously. We always want to talk about risks first. And there's something called blue sky laws, if you've heard of those. And you can imagine once upon a time, someone swindling people with snake oil that would cure your COVID-19, right? Or whatever, the Spanish flu at the time, So you can imagine there are all these terrible things that happen. That's why we have blue sky laws. That's why my industry is the most regulated industry in the world. And it needs to be because there are scams. So there's been a lot of private scams, not just real estate, but anything, venture capital, private equity, you name it. And Europe is much more conservative than the United States. They tend to be debt only. In the United States, we're more aggressive. We tend to look at equity more aggressively. Now, Europe's doing that too now, but traditionally Europe was debt only. The United States brought this equity idea to the manifold in a very aggressive way. So Americans were very aggressive about equity and taking risk, but it's important to know that there is risk. Now, how do you mitigate that would be the question. So really, it's about the managers. Who are the managers? And when I was a venture capitalist, it's real estate's location, location, location. Private investing is people, people, people. Because great idea, bad managers, it's gone, okay? You are looking at the strength and reliability of people. Are these people prudent? Are they putting the interest of the investor in front of themselves? What kind of terms do they have in their contract? So it really takes experts, and that's what we do as generalists, is we go to those experts, and we've become somewhat of an expert in real estate and other fields like biotech, and just by the fact that we've been doing it for a long time. But you want someone who's a fiduciary. You want the fiduciary to do good channel checks with their suppliers. You want customer referrals. You want interviews with the managers. You want to believe those people. I mean, it's just like you interviewed me, but we pre-interview to make sure Paul's a normal guy, right? So it's the same thing. I call them and I see, who are these people? What are they like? Are they people that I would trust? Are they people that I would let in my house? Are they people that I would let play with my children? I mean, there's these kinds of thoughts you have. And if this, on a scale of 1 to 10, the person is a 0 out of 10, should you be doing business with that person? So I think some of that is very good diligence you can still do. There is more scrutiny of the private side today than there was even 20 years ago, because there are organizations, there's angel investor groups, there's a lot of social networking, there's a lot of experts who can communicate with each other faster, better, cheaper today than even 10 years ago. And so, yes, but it is a risk, but I'd say that's the same for any private investment.
Okay, and so the advantage of doing it, right? So for moving away from the generally publicly traded liquid kind of assets that you normally associate with wealth managers into the private real estate world. What are the primary drivers for doing that? Why do you take on that burden now
That's
of
a good
going
question.
out and getting to know a sponsor? Tell me
That's
why is that a good thing?
very fair question. So first, the investors have to be qualified as accredited investors to do this. And that takes a fiduciary like myself to say you have enough assets and enough income. And if you lost this money, it would not detrimentally affect your life. So that's number one, is screening people. Number two is, so when I was a venture capitalist, if you're going to take that kind of risk where you have less liquidity, less transparency, less information, and you may have to hold it 5 years, you have no control over the sale, just like the sale of your home. It's difficult, right? We can't predict it. If you're going to do those things, the investor demands higher return. So the benefit to the investor is higher return. Venture capital, when I was doing biotech, my lead investment in Wolverine Venture Fund, Handy Lab, doubled the fund size, mine and the fund members. Over 5 years, we doubled the fund size. What that really means is that investment went up like tenfold. And some things went up okay, some things sat flat, some things lost money. We luckily had a 10 banger, so the whole fund did well. And so I let people know that there's high risk, but with high risk, investors demand high return. And if the high return doesn't occur, they move on to better organizations, right? So that's where you look at history. You can look at what are the returns in the past? How well have they interviewed managers? How well have they scrutinized those firms without micromanaging them to death? Because you can kill the company like Shark Tank. So, it's a balance, really. It's a balanced system where the more risk you take, you should have more return. Now, there are inefficiencies. And I'm pleased to say that the private market is one of those inefficiencies. If you have good research and you find good managers and you network well and you have a good system of due diligence, you may find private investments whose returns are well above their risk profile. So we've seen things in the 20, 30, even 40, 50% year-over-year return ratio, which is very, very attractive. Now, having said that, if we're seeing that kind of stuff, there must be stuff going to zero, right? And so that's what you have to do, is be able to tolerate the risk. The investor has to be able to swallow it if it doesn't go anywhere. It's a cherry on top if they win. They get to brag if they win. Who cares if they lose? That's how you have to treat it.
Fascinating. Okay, so one more question off topic. I know these weren't the questions that we had, but I'm
Right.
dying to know, and I know you know the answers. I'm going to ask you this. So now, when you go ahead and identify a sponsor and a project that you like, what is the structure, Paul? How do you set that up inside your firm to actually connect the dots between the investment itself, the deal, and the investor's equity? Are you creating an SPE? Are you creating a fund? Just tell me how do you do that internally?
How does it work? Yeah, it's good. Yeah. It's a good question. So I'm a broker. I was a Wall Street analyst. Luckily, I am a true independent broker. So you want to make sure first you're working with a fiduciary who puts your interests first and is compliant and follow regulations. That's number one. Number two is the private side. Really, people should have access and they don't. I mean, once upon a time, only the wealthy could go to the stock exchange where their servant would come with cash and they'd write a note and trade a stock or a bond. Now we got mutual funds, ETFs, bonds. We went from bonds to bond unit investment trust to bond funds so that the public had general access. Now the world of alternatives in the private market is moving in that direction, but it's not there yet. So to get through it, you have to go through a broker. I'm a broker, for example, and what we do is two ways. Number one is if it's a retirement account, there are private custodians who will take IRA money and they will essentially pool that IRA money, creating semi-liquidity in their pool because they might find a buyer or seller among their private investors who are interested in the same thing, semi-liquidity, and then they invest it. Okay, that's choice number one. Choice number two is you go direct to the capital company who's making the offering. They may have a PPM, a contract, and you go to that contract, you read it, you have to satisfy, as I mentioned, qualify as accredited investor. There's a lower level called suitability. And so there's two levels, two tiers. And so there's two ways, basically. You can find a private custodian who can then custody the money and pool it. Or number two is you can go directly to that organization and write a check to them. Now, obviously, the second one's more risky. If you're writing a check to ABC Capital Company and they just opened up, there's a possibility of fraud. If they've existed for 35 years and they have a track record of 25 successful private investments, you're probably okay. And so those are the two basic ways you can go. And I really encourage all investors to go from 0% private investing to 1. If you're at 1, go from 1 to 5. If you're at 5, go to 10. Just like foreign investing, half the world GDP is outside the US. We only invest in the US. So if you have 1% foreign, you should go to 5. If you're 5, you should go to 10, or you're missing out on growth. So you don't want to miss out on half the world's growth outside the US. You don't want to miss out on half the investments in the world, which are private. And so that's why I encourage people to truly diversify through alternatives, private and foreign.
So just one more question on this, just so I understand. So if you find a sponsor who's got a PPM and they want to raise money, and you're representing clients, you've got, I don't know, however many hundred clients and billions of dollars under management, and you want to channel some of that capital into that sponsor's project, are your investors writing checks directly to or your clients writing checks directly to the sponsor? And if so, how are you making a living from that? Is it not coming through like some kind of conduit that you have internally?
Correct. I've decided not to create a conduit internal. I think it creates a compliance and regulatory mess. It looks like a shell game. I just don't want to be involved in that. I don't think it's the right way to go. Look at Enron. I just don't think it's the way to go. So if it's IRA money, retirement money, ERISA money, if you go to a private custodian, it basically will say so-and-so's name, right? It'll say IRA, FBO, Joe Smith. So it's actually written to themselves, but it's held by a private custodian. If it's non-qualified money or post-tax money or a direct investment, you are writing it to that capital company. Now, they'll often create themselves a shell company that says XYZ Investment Pool LLC, okay? So that's the way. Now, how do I make money? On the private side, I don't want to get in the way of growth. When I was a venture capitalist, we didn't have a return for 3 years, which is actually very good. Sometimes it'd be 10 years. And so during that time, to take a fee makes no sense because all you're doing is harming the investment by taking capital away from the investment. So on the private side, what I do is take nothing until the end, and then I take what's called a 2 in 20, the same thing hedge funds do, 2% management per year, plus a 20% take on the profit. And by then, if we have a 10 banger, they want to give me more money. So 2 times 5 years would be 10, plus the 20 is 30%. They had a 10 banger, I'm taking 3-fold, they're taking 7-fold, and they're begging me to take more money, and I can't. So they want tax deductions. So that's the way to do it, is back end it so that while the investor is waiting and stressed out and not making any money, I'm also waiting. So I'm in conjunction with the investor and my interests are aligned with the investor.
Absolutely fascinating. So you take a 2% assets under management fee, whatever they put in
at the end
on an annual, not on an annual basis.
At the end. So again, if you take the 2% from the investment, you've hurt the investment. Right? You just hurt the capital.
Is that 2% per year or that's total 2%?
2% per year. So 5 years goes by.
Got it.
2 times 5 is 10%.
Got
plus
it.
a 20% take of the profit is 30%.
Fascinating.
It sounds like, wow, that's a lot of money. But I waited 5 years. And at that point, if they got 7x and I end up with 3x, they're begging me to take more money. And I can't.
Yeah. It's fascinating. That's a really cool structure. It's very interesting.
Thank
First
you.
time I've heard that.
The hedge funds came up with it first, not me. That's a hedge
really
fund.
Interesting. So you're back-ending all of your private real estate investing. So
Right.
You're motivated to find really good deals for your clients, right? Because that's how you're compensated.
Correct. That's correct.
Fascinating.
The way to do that too is through peers. I was in venture capital industry. I was on Wall Street as a sell-side equity research analyst. I kept a lot of friends. I put friends in good places. That's a good thing to do in your life, And that doesn't mean it's inside information, but you just know people in a lot of different arenas. And then you do a lot of screening, of course. Whenever there's a venture capital company that's owned by a parent company, I went to Northwestern, so we invest in the Purple Fund. But the parent company is called Academic Venture Group. It's the top 20 universities in the world, including Cambridge and Harvard and Stanford and University of Tokyo, the top 20. And they pool their resources, and they act as a flea on the elephant's back of big deals like Frazier and Blue Chip and Rockefeller, Venrock. And that's their way of basically shifting the due diligence to the large organization. So anything you can do to mitigate risk, you should do. With capital companies or private equity companies, we look at their background, I look at peers, I look at who the managers are. If I do that with companies, I do that with the capital company. Who are these managers? Do I trust them? Do I believe in them? What's their track record? Sometimes we'll monitor them 2 years just to see how they're doing. We'll go to conferences, but then out of hundreds of names, we might pick 30 that interested us. And from that 30, 5 only meet our requirements, and then we track them and see how they actually do, just like I was tracked when I was a sell-side analyst. You know, people are trying to decide.
So when you, so this structure that you described, that you put together, the 2 and 20 is entirely back-ended. Just curious, have you seen any other types of structure that wealth managers use? Just kind of give me a description, say whatever you've seen, what is the most, the way that they set up typically?
Absolutely. There's 2 others, Adam. And on the public side, we use the asset under management fee. We charge 1. Our sub-advisor, Sterling Capital, charges 0.5. So we're 1.5 all in. They're the 401k for FANG, for Facebook, Netflix, Amazon, Google. So imagine if you have a choice between investing more of your stock in Google or you have to go to your 401k, it better be good. So we use a sub-advisor because I can't know everything about everything. So we're 1.5. And then some people do commissions. We don't do commissions because I think it creates a conflict.
Specifically for real estate. No, I'm talking about specifically.
I understand. So when you apply it to real estate, then you could do an asset under management each year. And when I've tried that in the past, it makes the investor very nervous because they have to write a check to our firm, right? Because they invested $100,000. We're not going to take $1,000 out of the investment. That would make no sense. So they actually have to write a check. That creates a lot of nervousness around the investor. And then they could charge commissions or do what you said, create a shell company and actually become a kind of private equity company themselves. I think that creates a different type of conflict of interest, where how could you say you're passive if you're actually a company that's involved? Now you're involved, and then your investors ask you a question, now they're involved. They can't claim passivity, and then they can't get the tax deduction for being a passive investor. So I think it creates too many problems. That's why we chose the model.
Fascinating. All right, Paul, so let's get back onto our agreed list of questions. Now that we've kind of diverged a little bit.
Okay.
All right, but this actually, it's actually a really good segue. All right, so now that we know how you structure everything, tell me about the strengths and weaknesses of private real estate.
Okay. Yeah. I'm going to be very picky, Adam, because what I'm going to tell you right now, I would not have said 2 months ago. Okay, and I would not have said in 2009, for example. Okay, so I feel that the situation we're in, you said the COVID crisis, the situation we're in, I believe should be categorized as a government action. And since if it's a government action, that means it can be reversed, right? So look at China and South Korea where they reversed it and they're getting back to normal. So now it could become a recession or depression if it drags on long enough. And I very much believe in the sort of the U recovery with a possible second U or a small W if we haven't yet again next season, okay? So the reason I'm stating that is that I think that's important to the thesis of what do you do in the private side. When we have this kind of situation, let's say it is a recession or it looks like a recession, okay? Whether it's the government action or a recession, it looks and acts like a recession. So if it looks and acts like a recession, there are 2 areas among kind of 5 sectors within private real estate that I particularly like right now. Multifamily unit and rentals, okay, like apartment rentals. If you look back in 2009 to 2012, what parts of real estate did well? Those 2. Why? People couldn't buy homes. Factories were not expanding. Industrial wasn't expanding. They couldn't get loans. So what was actually going up? Rentals, okay? So you saw rentals, multifamily unit, condos, apartment complex, rent. And so if you're investing on the private side of real estate, my recommendation, TurnKeough recommendation, is rent. Because people, especially millennials, a lot of millennials I feel are really in unfortunate situations where they can't invest the way I did. I'm 50 when I was in my 30s. So I feel really feel a pain for them. And what's the challenge for them and everyone is that rental actually goes up in recession, right? It's kind of hard to find the things that work in recession, right? It seems to be a strange thing to say, but in every phase of the economic cycle, you can make money. So in recessions, you can make money off rentals, and rental income is very steady. In fact, your occupancy goes up. Instead of 75 to 85, you might have 90 to 95% occupancy, and multifamily unit goes up as well. Townhouse or townhouse strips, you see those in the UK as well, the townhouse strips, and people rent them out. I mean, so you get the townhouse communities are completely filled up. And so if you're investing, that's where you should go. I don't like industrials. I don't like a single family because those are debt-based, and if the debt blows up, you're back to the derivative crisis. I don't like industrial because you have to put large amounts of investments into them intermittently, and you can't predict when it's going to happen. You need new air conditioning. There's asbestos. A new regulation comes on board, and now you got to do this, that, or the other thing. And so those are the 2 particular areas that I do like.
All right, so we got into specific niches, but tell me something about the advantages of investing in private real estate. Like, for example, correlation. We talked about this a little bit.
Yeah.
Non-correlation with the stock market, illiquidity premiums, presumably, et cetera, et cetera. So tell me something about as a kind of as a
So why would you
asset
do it?
class alone. Yeah, the strengths and
So,
weaknesses.
so why are you doing it? Well, one is the rental income, as I was saying. And if you're retired, retirees, they want distributions that are going to satisfy their expenses. And the growth rate has to beat their distribution rate. I work with a lot of retirees. Retirees have to R&D that's required minimal distribution of their retirement accounts. That could be 3 to 4%. So the investment better double that number. You better get 7 to 8% growth every year consistently so that they're not draining their IRA accounts and running out of money. So when you think of that position, it's a really good fit for an IRA for a retired person. Now, the active person. For the active person who's working and thinking, do I want to put my money in private real estate? You don't have to take the distribution. You could take that growth, and the growth, just like dividends, could be reinvested. And so if you can get a 7, 8% steady growth while the market's going down, you could be 40, 50% above where the really market is because you're going up and the market's going down. And so it's a really good hedge on a recession. That would be the second reason that you think of income meaning rent, as a good source because you don't have to distribute it to yourself. Remember, like a dividend, you don't have to take the dividend. You could just have it reinvested. You don't have to take the coupon from a bond. You could have it reinvested. So the same thing with rental income. You don't have to take the rental income as income and distribute it to your own checking account. You could just have it sit as cash and reinvest it back into the property or a different real estate investment. There's a third reason. The third reason is really specific to people who sell their property or sell a business or sell a piece of land. It's something called a 1031 exchange. If you sell land and you would have had to recognize capital gains on that land at a certain point, if you do a 1031 exchange into a private REIT or real estate investment, like in kind, you sold real estate and you bought real estate, there's no tax consequence. And so there's a third reason that private real estate is very attractive. And there's scale from very large companies to very small. The very large ones, you got liquidity. The very small ones, you can get that really high return. And so that's how people think about it. They think, where do I want to put the money? Do I buy a McDonald's? Right? You could do that. Do I buy a house and become a landlord myself? That's pretty messy. And what if they Section 9 on you and you can never get rid of them and they don't pay the rent? Okay. Or do I go with a huge conglomerate that's dealing with thousands and thousands of rental units and they manage it and I just passively get income and some of that's pass-through income? And so that's why people look at 1031s in retirement. You got to work with a fiduciary and you got to work with a good tax lawyer who knows how to do 1031s so you don't get taxed.
Exactly, yeah. So the tax code is obviously, private real estate is definitely tax beneficial, isn't it? All right.
Double in a way, because you've got the tax benefit of the 1031 exchange, and then you have the pass-through as well. So there's really two tax advantages to real estate.
Paul, you and I could talk for hours about this, but I know that we had a specific amount of time. So I'll tell you what I'm going to do. I might come back to you later if you don't mind, because I'm enjoying this conversation very much. And I do actually have some other themes I'd like to explore with you. But for today, let's go ahead and wrap up. I've got 3 questions. I'm going to take you completely by surprise with 3 questions, but don't worry, because I know that these are easy questions to answer. And I ask all of my guests the same 3 questions. The first one, this is an interesting one. Now, you are probably one of the most highly qualified people I've ever spoken to. A PhD, an MBA, a CFA, a PD thing, and whatever you've got everything. It's like the letters after your name are longer than your name. I know you're a very bright fellow. So let me ask you this. What has been the hardest lesson you've learned in business throughout your career?
Yeah, the hardest lesson is that when something's not working, you need to correct as soon as you know it's a problem. This is very hard for people to do. It's easy to say, but it's very hard for everyone to do. If you hire someone and in a month you realize this person is not a fit, you need to let them go. You need to hire slow and fire fast. The same thing with investment. If you thought the investment was going to do something and you discover something else is going on, something unexpected or inappropriate, you have to confront them, and I do that. And then I tell the investors, we're out of here. Cut your losses and you move on. Buying is easy. Selling is very hard. And I think that is really the hardest lesson of all is when you see something and your gut is telling it's wrong and you verify that in some manner, you talk to them and you look at numbers and you verify it truly is a problem, act. And act quickly and stop the bleeding.
Fabulous. All right. Second of 3 sign-off questions. What are the key daily habits that you have personally that make you successful?
Oh, that's a great question. I love what I do. When I'm asked what would be your dream job, I'm like, it's this one. I love what I do. I love people. Love helping businesses and families with their financial situation. What helps me is I keep my meetings short. You've seen my Calendly is 15-minute meetings. And I do that intentionally. I may end up longer than that, but there are many people to reach. There's a lot of people who need help. So whenever I sit there and I can't think of something to do, there's something wrong with me. I have a picture opposite me that you can't see, and it's a fisher of men. It's a man out on the ocean catching fish. It's a Christian symbol of fishing for men. And I look up at that if I can't think of something to do, which is very rare. And I look at that just for an instant. It reminds me of my job is to be a fisher of men, is to help people with their financial situations. Wall Street, all I could do is help the rich get richer. On Main Street, I'm helping small businesses and the average family fulfill their dreams. It's very exciting what I do, so I don't find it hard to be motivated.
That's fantastic. I actually tell my son, you got to find something that you really love. If you can find something that you really love, you'll never work a day in your life.
That's right. That's right. That's absolutely true. That's absolutely true.
All right, now I got a last question. I'm actually going to adapt this ever so slightly, Paul.
Okay.
And it's like this. So what advice would you have to a wealth manager or an RIA whose clients are interested in investing in private real estate, but who does not yet invest or provide that service to their clients? What advice would you give to those wealth managers about getting into private real estate?
Yeah, you got to take your time. Find a good mentor. You can reach out to us if that's okay, TurnKeough.com. It's really up to you, but we have good mentors too. I mean, I have people I go to because I was a biotech analyst at Wall Street. How I got into real estate was as I realized that some of the way they made money was rent off their buildings when they didn't have a drug yet. And so I started looking at real estate. But you want to do your homework, of course. Do your diligence, get good mentors, attend conferences. I'm very much a believer, like Adam and I are doing right now. We're looking at each other and we're seeing each other's facial expressions. Get in front of them. Get in front of the capital companies. Get in front of the REIT companies. Go to those lunches and dinners that they offer. Sit down with them. Bring them to your office. Take your time. Track the companies you think might do well. I've bifurcated to the really large names and the really small names because the middle ones are just too confusing. So I like the really big, large REITs, and I like the really small capital companies. And that was my decision. But you might decide you like the middle because it's more diversified. But to do that, you got to track them. I would spend at least 2 years tracking the ones you thought were the good picks and learn to be burned before you burn the investor. Burn your own ghost portfolio, not your investor.
That's a really brilliant idea, actually.
I learned it from the big guys, Citadel, Fortress, Fidelity. Those are my clients, and that's what they did to me. They wouldn't listen to my advice for 2 years. So they just said, we want to see how you do. We want to see which name does well. And so I did the same thing because it's logical that you think it's a good idea, you get excited, but you also need to verify that it is, and time is a very good way to verify.
Paul Keough, TurnKeough Wealth Management. What a pleasure meeting you. What a pleasure talking to you. Thanks so much for being on my podcast and for spending time with me today.
Thank you very much, Adam. I appreciate it.
That was Paul Keough of TurnKeough Wealth Management. Be sure to check out the COVID resource or the COVID-19 resource page at gowercrowd.com. There's a tab there on the top of the homepage to access all the resources that I've put together for you there to help you through these really crazy times. There's a lot there, including some free training, other podcasts, articles, discounts off our flagship investor acquisition system, online master course, and a bunch more. That's all going to be there for you on the podcast page at gowercrowd.com. Plus, you'll find links to Paul and his firm so you can contact him directly. All right, that's it. Thanks so much for listening. And thank you, Paul Keough of TurnKeough Wealth Management, for your time with me today. It was a real pleasure meeting you. Thank you. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.